The TSX fell 233 points on Tuesday. Oil was above 110, tech stocks were bleeding, and the Bank of Canada's next rate decision was casting a shadow over every trade. When oil's up, everything else goes down, said Brian Madden of First Avenue Investment Counsel, and today that was exactly the script. The Nasdaq dropped 223 points. Broadcom sank 4.4%. Nvidia slipped 1.6%. The catalyst was a Wall Street Journal report suggesting OpenAI executives have doubts about whether the massive AI infrastructure build-out will generate returns fast enough to justify the spending. It was a small signal from one company, but it rippled across the entire AI trade. Meanwhile, Brent crude held above 110. The UAE's shock exit from OPEC added fresh uncertainty to an oil market already rattled by 9 weeks of Iran-driven supply disruption through the Strait of Hormuz. Shell's $22 billion acquisition of ARC Resources, the largest deal in Canada's oil patch in over a decade, underscored that some of the world's biggest energy players are betting heavily on Canadian hydrocarbons precisely when geopolitical risk is rewriting global supply routes. That was the backdrop. Then, at midday, Prime Minister Mark Carney did something no Canadian leader has ever done. He announced the creation of Canada's first sovereign wealth fund. Canada's new sovereign wealth fund is called the Canada Strong Fund. The announcement landed in the same spring fiscal update that revealed Ottawa is still running a deep deficit, projected at nearly $50 billion this fiscal year, down from earlier estimates but still among the largest in Canadian peacetime history. Here's what makes this notable. Sovereign wealth funds are built on surpluses. Norway's government pension fund Global, the world's largest, now worth over $1.7 trillion, was seeded with North Sea oil revenues that exceeded what the government could spend. Abu Dhabi, Singapore, Saudi Arabia, the template is the same. Accumulate excess, invest it, let it compound across generations. Canada has no such surplus. Its federal debt is approaching $1.4 trillion. The spring fiscal update, tabled Tuesday, showed continued deficits stretching across the forecast horizon. Fred O'Riordan, national leader for tax policy at EY, told CTV News that ordinary Canadians who are looking for pocketbook savings will be disappointed with this spring economic update. So where does the Canada Strong Fund get its money? The government has not specified. The announcement described the fund's broad mandate to invest in Canadian infrastructure, critical resources, and long-term national priorities, but left the capitalization mechanism unresolved. That blank line is the entire question. There is a scenario where the logic holds. Canada is sitting on some of the world's largest undeveloped energy and critical mineral reserves. Shell's acquisition of ARC Resources reflects a global re-rating of Canadian hydrocarbon assets. If Ottawa structures the fund to capture royalties or equity stakes from future resource development, particularly from LNG Canada expansion and new pipeline capacity, then the fund could generate its own seed capital over time, without drawing from consolidated revenue. That would be a different model from Norway's, but not incoherent. The problem is that it requires the projects to actually get built, the permits to be issued, and the revenues to flow. None of those are guaranteed. The Liberals' own fiscal update noted the country is navigating a rapidly changing and increasingly fragmented world, language that doubles as a hedge against the projections embedded in the document itself. There is also a simpler read. The Canada Strong Fund is a political announcement more than a financial one. Carney has staked his government on a vision of Canada as an energy and infrastructure superpower, distinct from the Trudeau-era regulatory tightening. A sovereign wealth fund, even one with no money in it yet, plants a flag. It says, we are building something that lasts beyond this election cycle. Whether the markets believe it is a separate question. The evidence so far leans towards cautious credibility. Shell's $22 billion bet on Canadian gas is not a political gesture. It is a capital allocation decision made by one of the world's largest energy companies, and it validates the Carney government's pitch that Canada can attract serious investment by fast-tracking projects. The Globe and Mail's headline Tuesday read, Shell's ARC deal seen as win for Mark Carney's pro-oil pivot. Deutsche Bank's forecast of $8,000 gold by 2031, published this week, adds another dimension. The thesis is built on de-dollarization. Central banks in emerging markets are replacing U.S. dollar reserves with gold at a pace not seen since the 1970s. If that trend continues, commodity-rich economies with hard assets in the ground, like Canada, hold a structural advantage. A sovereign wealth fund designed to capture that upside is not a fantasy. It has a historical precedent, just not a Canadian one. The condition that makes the Canada Strong Fund real is sequencing. LNG Canada expansion needs to proceed. Pipeline capacity to the Pacific needs to come online. Royalty frameworks need to be renegotiated to direct resource revenue into the fund rather than into general spending. If those steps happen in that order, the fund has a funding mechanism. If any one of them stalls, a court injunction, a federal-provincial dispute, a commodity price collapse, the fund becomes a holding company with no holdings. The condition that exposes it as theater is simpler. If the government draws on consolidated revenue to capitalize the fund while the deficit is still running above $40 billion, it would be borrowing money to create the appearance of savings. That would be a meaningful shift in fiscal character, and bond markets would likely notice. The Bank of Canada announces its next rate decision Wednesday. With inflation nudging back up on fuel and groceries and the deficit wider than voters expected, the language around the path to rate cuts matters as much as the decision itself. The TSX oil patch held up Tuesday. The broader index did not. The question heading into Wednesday is whether the Sovereign Wealth Fund announcement signals a coherent long-term strategy, or whether it is the headline from a fiscal update that, as one analyst put it, continues to dig a deeper hole.